Swiss Franc Forex Options by www.options-trading-education.com. Don't you wish that you had been on the right side of a Swiss franc Forex options trade when the Swiss central bank took the cap off of the euro-franc exchange rate? For those of you who missed the story, here is the short version. And this is a lesson in options trading return on investment versus straight trading. The Swiss economy and the Swiss franc. The Swiss franc is often considered the ultimate safe haven currency. The Swiss economy is well managed, and the Swiss franc commonly strengthens against other major currencies. So when economic times are difficult, war threatens, or other currencies weaken, investors and forex traders buy Swiss francs. This drives up the value of the franc. Because Switzerland has an export economy, they cannot afford to have a currency that is too highly prized, or their exports will not be competitive. For the last few years, the Swiss central bank purchased euros with francs whenever the euro weakened below 1.2 to the franc. Troubles with the euro makes a policy expensive. The European Union is in danger of falling back into recession. The long-delayed remedy will be a quantitative easing stimulus program by which the European Central Bank will purchase government and corporate bonds, drive down interest rates, stimulate business, create jobs, and drive down the value of the euro. The Swiss central banks saw this coming and counted the cost. They changed their monetary policy in a heartbeat by stopping all purchases of the euro. The immediate result was that the Swiss franc traded as much as 40% higher versus the euro, and then settled back to being worth 30% more in euros than it was the day before. How Forex traders fared. A very popular strategy in Forex options trading has been to assume that the Swiss central bank would be purchasing another batch of euros, and that the euro would go up a little and the franc would fall a little. First, let us look at regular Forex trading. Traders typically trade with 20-fold leverage. Thus, a trader who was trading $20,000 on margin with 20-fold leverage was really trading $600,000. When the Swiss franc went instantly by more than 30%, he or she was in the red. $180,000 minus $20,000 equal $160,000. Because the trader could not meet this margin call, his brokerage house needed to make payment. Several trading houses lost hundreds of millions of dollars, and the total set of losses may be in excess of $1 billion. On the other hand, a trader who was betting that the franc would rise made a profit of $180,000 in the same situation. Let us compare this to Swiss franc options trading. The worst that the buyer of an options contract will do is lose the premium or cost of the contract. The best that he or she will do is make the same gains as a regular trader minus the premium he pays. No matter what our options trading strategy, if you are buying options, your risk is limited. As always, stay out of trades that you do not understand, and avoid selling options contracts unless you have made purchases to balance your risk. For more insights and useful information about trading options, visit www.options-trading-education.com.